Hey everyone! Welcome back to my channel Trading with Nimve. In this video, I'll be discussing a strategy based on exponential moving averages crossing over. We will develop this strategy using past candles, and we will find a responding currency pair for this strategy. If you're new here, make sure to hit that subscribe button and turn on notifications so you never miss a video. Moving averages are one of the most popular tools in technical analysis, and the exponential moving average is a particularly useful one that can help you identify potential trend reversals. In this video, we'll cover everything you need to know about the exponential moving average cross strategy, including how to set it up and trade with it. And we will try to provide a live trading example so you can see how it works in action. First, let's start with the basics. An exponential moving average is a type of moving average that places more weight on recent price data. This means that exponential moving average are more responsive to changes in price and can provide more timely signals than simple moving averages. The exponential moving average formula also gives more weight to the most recent price data, which is why it's called exponential. Now that you know what an exponential moving average is, let's talk about the exponential moving average cross strategy. This is a simple yet effective trading strategy that uses two exponential moving averages of different periods to identify potential trend reversals. The periods used will depend on your trading timeframe and preferences, but a common combination is the 20 exponential moving average and the 50 exponential moving average. To set up the exponential moving average cross strategy, you'll need to add these two exponential moving averages to your price chart. As you can see, the 20 exponential moving average, blue line, crosses above the 50 exponential moving average, red line, indicating a bullish crossover. This is a potential signal to enter a long position. Before we begin implementing the exponential moving average cross strategy, we need to first identify the currency pair that will respond well to this particular trading strategy. One way to do this is by analyzing the charts and identifying trends. The exponential moving average cross strategy is a well-known and widely used trading strategy due to its simplicity and potential for success. However, it's important to note that despite its popularity, many traders may be implementing this strategy incorrectly. This can be due to a variety of reasons, such as misinterpreting the signals or not properly analyzing the market trends. As a result, these traders may not see the desired results and may miss out on potential profits. Therefore, it's crucial for traders to take the time to thoroughly understand and correctly implement the exponential moving average cross strategy. By doing so, they can increase their chances of success and avoid falling into common pitfalls that may hinder their trading performance. One of the most common mistakes that traders make when implementing the exponential moving average cross strategy is to blindly take a position every time the moving averages cross over. This approach involves taking a buy position when the faster moving average crosses above the slower moving average, and taking a sell position when the faster moving average crosses below the slower moving average. However, this approach can be detrimental to a trader's success because it only works well in trending markets. In range-bound markets, this method can result in an excess of false signals that can quickly lead to losses and ultimately wipe out a trader's account. To avoid falling into this trap, traders should take a more cautious approach when trading the exponential moving average cross strategy. Another common mistake that traders make when using the exponential moving average cross strategy is using too many moving averages. While it may seem logical to use multiple moving averages to increase the accuracy of signals, in reality, using too many moving averages can lead to delayed entry signals. The more moving averages a trader uses, the later the entry signals will be. For example, if a trader is using two moving averages, the 20 period and the 50 period, and the 20 period crosses above the 50 period, they can take a buy position at that point. However, if a trader were to add another moving average, such as the 200 period, their entry signal would be much later than if they only used two moving averages. Therefore, it's important to remember that when it comes to moving averages, less is often more. Traders should focus on using a small number of moving averages that are most relevant to their trading strategy. By doing so, they can ensure timely entry signals and avoid missed opportunities. Remember, while using multiple indicators may seem like a good idea, it's essential to prioritize accuracy and timely signals. By keeping things simple and sticking to a few key moving averages, traders can increase their chances of success and avoid unnecessary complications in their trading strategies. Another mistake that traders often make when using the Exponential Moving Average Cross strategy is applying it to lower time frames. While it may seem tempting to use this strategy on shorter time frames in an attempt to generate more frequent trading opportunities, doing so can actually lead to poor results. Lower time frames tend to have less clear trends and more range-bound markets, which can result in an abundance of false signals and missed opportunities. Additionally, shorter time frames are more susceptible to market noise and price volatility, which can further complicate trading decisions. To avoid these pitfalls, traders should focus on using the Exponential Moving Average Cross strategy on higher time frames where market trends are clearer and more consistent. This can help to reduce the risk of false signals and improve the accuracy of entry and exit points. Here's how I recommend trading the Exponential Moving Average Crossover strategy. First, focus on using two moving averages, such as the 20 period and 50 period, as these are often the most effective for generating timely signals. The next step is to choose a high time frame for your analysis. I recommend using the daily time frame for this strategy, as it provides a clear and consistent view of the market trends. However, if you prefer to use a lower time frame, you can use the 1-hour chart instead. Once you have chosen your time frame, select a currency pair and analyze how the market is reacting to the moving average crossover. Look for clear and consistent signals, as well as any potential false signals or choppy market conditions. This will help you to identify the most favorable entry and exit points and avoid unnecessary losses. Let me show you what I mean. If you zoom out and take a closer look at the 20 period and 50 period moving averages, you may notice that the price tends to not always react to the crossover. In some cases, the market may exhibit choppy, unpredictable behavior that can result in false signals and missed opportunities. For example, in the chart, we can see that the moving average crosses over downwards, but instead of following the crossover and continuing downwards, the price reverses and heads back up. Similarly, we can see that the moving average crosses upwards, but the price instead goes downwards. This indicates that this particular market has a history of not reacting well to the crossover strategy. Let's take a look at another currency pair that may be better suited for the crossover strategy. For example, if we examine the EUR-GBP pair and zoom out to look closely at the 20 period and 50 period moving averages, we can see that the market tends to react well to the crossover signals. As we can see in the chart, when the moving average crosses over upwards, the price follows the signal and begins to trend upwards. This indicates that the EUR-GBP pair is well suited for this strategy, and we may be able to use the crossover signals to identify profitable trading opportunities. Looking at the EUR-GBP chart in more detail, we can see that the moving average crossover strategy works well on this pair. As we can observe, the 20 period moving average crossed over the 50 period moving average upwards, which triggered a signal for a potential uptrend. And as we can see from the subsequent price action, the market followed the signal and began trending upwards, confirming the validity of the crossover signal. We can observe similar behavior in the chart when the moving average crossed over downwards, which signaled a potential downtrend and was confirmed by the subsequent price action. In fact, this pattern has repeated multiple times throughout the chart, indicating that the EUR-GBP pair is highly responsive to the moving average crossover strategy. By identifying pairs like this, we can increase our chances of success and potentially profit from the trading opportunities that arise from the crossover signals. So I will confidently trade the crossover strategy on this market, but remember, just because a market reacted to the crossover in the past doesn't guarantee 100% that it's going to do that again in the future. In the case of EUR-GBP, after careful analysis, I have found that the 1-hour chart is responding very well to the strategy. This means that the market tends to react positively to the signals generated by the moving average crossover on this time frame. By using the 1-hour chart in your GBP, I have been able to identify clear entry and exit points based on the moving average crossover strategy. This has enabled me to make informed trading decisions and achieve profitable results. In the upcoming video, we'll delve deeper into the trading strategy we've been discussing and take it for a live test drive. This will provide us with a real-time opportunity to observe the effectiveness of the strategy and gain valuable insights into how it operates in the markets. We'll be placing several orders and monitoring their behavior using the moving average crossover method. This exercise will help us to understand the nuances of the trading system, its strengths and weaknesses, and how we can optimize it for maximum profitability. Additionally, we'll also discuss risk management techniques and ways to minimize potential losses while maximizing gains. So, get ready for an exciting and informative session, where we'll put our knowledge into action and gain practical experience in the trading world. In the meantime, subscribe to our channel, Trading with Nimve, and click the bell icon to stay updated with our latest videos. Until the next video, stay hopeful.